If you believe Warren Buffett became one of the richest men in history because he picks great stocks, you are studying the wrong skill. Stock picking is visible. Capital allocation is invisible. And invisible systems are what compound for decades. Inside Berkshire Hathaway, cash does not sit idle. It competes. Every dollar must justify its existence. It can be reinvested. It can acquire another business. It can buy public companies, or it can buy back Berkshire itself. Only one door creates the most value. Capital allocation is not about action. It is about comparison. Every dollar inside Berkshire competes against every other option. Nothing is automatic. If reinvesting in an existing business creates 15% return, but acquiring another company creates 20%, the dollar moves. When Apple can reinvest at high incremental returns, it keeps capital. When returns shrink, capital should move elsewhere. Allocation is not about loving a business. It is about loving the return. Capital has no loyalty. It goes where it is treated best. Buffett does not ask, "Do I like this company?" He asks, "Is this the best use of capital today?" That is why Berkshire reduced its position in Walmart between 2016 and 2017 as returns became less compelling. And during the same period, it aggressively increased its position in Apple. Capital moved, not because of emotion, because of return. That is capital allocation discipline. Retail ROIC doesn't fall because managers get stupid. It falls because the business absorbs more capital to earn the same dollar. There are three forces. Price competition compresses margins. E-commerce raises fulfillment capital. And wages and shrink raise operating drag. The real damage is incremental ROIC. Each new store, each new delivery promise needs more capital than the last one. Apple's advantage is not growth. It's that growth requires less incremental capital. Three levers create Apple's incremental returns: pricing power, ecosystem lock-in, and buybacks that increase per-share capital efficiency. Retail compounds by building more. Apple compounds by extracting more from what already exists. That's why capital moved. Not because Buffett changed his taste, because the economics changed. Retail grows by building more stores, more inventory, more logistics. If you want more sales, you must open more locations. If you open more locations, you must invest more capital. Capital gets locked in buildings and a stock, but retail margins are thin. Competition is constant. So profit grows slowly while capital grows quickly. Incremental return falls. The second dollar works harder but earns less. Apple grows differently. Retail must build more to earn more. Apple does not. When someone buys an iPhone, Apple does not just sell a product, it creates an ecosystem relationship. The same customer generates more value over time without building another store. Let's use simple numbers. Retail invests $1 billion and earns $80 million more. That's 8%. Apple invests $1 billion and earns $200 million more. That's 20%. Capital moves to where the second dollar works harder. High returns attract competition. Competition destroys return. So why didn't Apple's incremental return collapse? Because Apple is not selling hardware. It is selling an ecosystem. When a user switches, they lose data, apps, familiarity. Switching has a cost, and that protects return. Services scale differently. Adding one more subscriber does not require building a new store. The marginal cost is low, but the margin is high that keeps incremental return elevated. And when Apple cannot deploy capital at high internal returns, it returns capital. Through buybacks, reducing share count increases ownership per share. That preserves capital efficiency. Most investors compare companies. Buffett compares capital structure and the power of the next dollar. High returns never last forever. At some point, incremental return declines, growth slows, competition adapts, valuation compresses. This is where most investors freeze. Buffett does not. He does not fall in love with the company. He re-evaluates the next dollar. If the next dollar no longer earns superior return, capital moves again. Buffett does not chase growth. He follows return. And when return changes, he moves.